Good evening, everybody. My name is Abhishek Tiwari, and I'm your host for the evening. We bring you yet another episode of our updates on the product from the Global Suite. This time around, we are doing the Emerging Market Fund. And like every time, let me take a couple of minutes to set the context, tell you as to why the Emerging Market Fund, first of all, was launched into India. What is that problem that we are solving for at PGIM India? As all of you know, I think the platform is very, very clearly positioned as a solution-oriented platform. So let me state some facts for the emerging markets. All of us here may be aware that over the last 2 decades, or maybe a little more, emerging markets has clearly been adding much more to growth of the world GDP than the developed market. Having said that, yet the emerging markets have really detracted in performance, specifically over the last decade versus the developed markets per se. Now, what is it that's the missing link? And I'm sure we'll demystify that with the help of our panel of experts today. But let me state one more fact. I think while we are all aware that the nominal GDP growth rates for emerging markets are better than developed market counterparts, when we look at the broader set of indexes that we look at, we do not see enough representation of those growth opportunities. And that's exactly why this product got launched. And I'm sure a panel of experts will talk about much more on that aspect as well. So on that note, let me quickly introduce our panel of experts today. We have Sara Moreno, who is the MD and Portfolio Manager for the Emerging Market Portfolio. And we have Douglas Richardson, who you may all be acquainted with much more, as he has been into quite a few of our calls over the last quarters. He's the Managing Director and also the Client Portfolio Manager for the Global Equity Investment Team. Now, Sara, before handing it over to you, let me quickly pose the big question here. Do you actually see a rainbow while the dust storm is settling? And I'm sure the audience wants more and more inputs on that. But on that note, let me stop and hand over the podium to you.
Thank you so much, Abhishek, and thank you so much for everyone for making the time to meet with us today. And I would say that yes, if you're an investor with a long-term horizon, the answer is astoundingly yes. But of course, we start with 2020, a quick recap, where following in lines with your commentary, Abhishek, emerging markets returns did disappoint in 2021, posting a negative 2.5 return, failing to meet the high expectations that we had at the start of the year, despite the fact that there was an improving global economic backdrop and significant developed market liquidity supporting that. There really turned out to be more headwinds than tailwinds during the year, and they were led by several factors. The predominant one, as I will show you in the presentation, is China, where weakness in the commercial property sector, a regulatory crackdown in technology, and subsequently more sectors of the economy, as well as the zero COVID policy, led to emerging markets underperformance. We also had a rising US dollar, which always tends to weigh negatively on emerging market assets, rising interest rates across many emerging markets to curb inflation as it ticked up globally, a slow start to the vaccination campaigns across many emerging markets, and finally, a rotation to value led by the value growth gap that had widened very materially throughout 2020 and the global cyclical recovery as the world emerged from the pandemic. So 2021 turned out to be the worst relative year in EM versus DM since 2013, when we had the taper tantrum. But unlike 2013, the underperformance was led by China. So as you can appreciate in slide 3, when you look at the performance by countries, you can see that only a handful of countries outperformed. But also what's notable in the slide that by the fourth quarter, the very countries that had led in the outperformance started to really underperform. So it really points to the volatility that we saw across emerging markets throughout the year, and in particular in the back half of the year. If you go to slide 4, you can also see something else, and that is that the sectors that led the outperformance in emerging market were in what is more typically value sectors such as energy, utilities, and materials, which led the returns for the full year, while growth sectors like consumer discretionary and healthcare lagged. As a reminder, The Prudential Jennison Emerging Markets Equity Strategy takes a bottom-up fundamental, active, unconstrained, and concentrated approach to investing in emerging markets. We don't look anything like our peers, as our strategy really focuses on finding truly dynamic companies across emerging markets that have a secular growth underpin. I'll hand it now over to Doug, who will provide more color on this.
Thank you, Sarah, and good evening, everyone. As part of today's presentation, I will reinforce the reasons why we take an active and growth-oriented approach to investing in the emerging markets. I will also touch briefly on the environment that we are in today, and then I will turn the presentation back over to Sara, who will provide a portfolio update. On this page, page 6, which you've seen before, we provide evidence of why we invest in the highest growth part of the market. The data on this page is a good reminder of where equity returns are generated over long periods of time. If you analyze historical rolling 5-year periods, it is intuitive that the companies that are generating the fastest growth over any 5-year period have dramatically outperformed the overall market. The top quintile has delivered an average return of 16.2%, which is 20 times, actually 3 times the return of the lowest quintile of growth, quintile 5. The top quintile is where you find the big growers, companies that are innovative and disruptive, and the second quintile, which return an average of 14.2%, typically contains stable double-digit growers who are actually the hardest to find in the market today. And if you are focusing on the top 2 quintiles of growth, you have a better chance of winning over time, irrespective of the macro environment. And it's a great reminder of why we invest in this area, because that's where the returns are generated over time. Let me just restate what I said. Quintile 1 is 20 times the return of quintile 5. I just unfortunately can't see it on the far right of my chart. But historically, on average, our portfolio has had an allocation of over 70% of its weight in the top 2 quintiles of growth, which has really been a strong driver of alpha for us since the portfolio's inception. However, over short periods of time, our style can be out of favor due to different market factors, which is what's occurring in the market today. Since the US Federal Reserve changed their stance on inflation in November by removing the word transitory from their assessment, a rotation of growth stocks has occurred globally, and our portfolio has been impacted. During the current rotation, which began 2 months ago, the graph that you see on this page becomes inverted. Over the last 2 months, the companies with the best expected growth over the long term, quintile 1, are down almost 7%. And the companies with the worst expected growth, quintiles 4 and 5 on the far right-hand side of the page, are up an average of 2 to 3%. This is not normal, and it's more evidence to us that we are in a rotation. And importantly, it's not fundamentally driven. And because it's not fundamentally driven, rotations similar to these that we've seen in the past tend to be very short-term in nature. If we move to the next slide, slide 7, one of the other things that is interesting is how the equity market has changed over the last 20 years. It has to do with the following number of high growers in the market. High growth companies are now part of an exclusive list in any market. On this graph, you can see that growth is becoming more concentrated in the emerging markets. Back in 2008, over 70% of the companies were delivering revenue growth of greater than 15%, but that number has been cut to approximately 30%. We believe this is directly related to the lack of long-term catalysts that have a major impact on the cyclical part of the market. High interest rates, sustainably high commodity prices, and long-term robust economic growth, things that we believe are in jeopardy over the near term. Also, many traditional cyclical industries are getting disrupted by growth companies. For example, fintech, renewable energy, electric vehicles are just some of the new technologies disrupting existing traditional cyclical industries. Growth is a scarce resource. There are sustainable growth opportunities in every market around the world, but it's a pretty short list. On the following page, page 8, we show 2 pie charts, one representing the breakdown of the portfolio and the other representing the breakdown of the benchmark. The point of these charts is to highlight the primary differences of how we invest versus the market. As you can see from the chart on the right, almost 60% of the benchmark is comprised of defensive and cyclically sensitive industries and sectors. And only 40% is defined as, true secular growth. The makeup of the benchmark is the prime reason emerging markets investors have been disappointed with the returns over the last decade. Index funds replicating the benchmark and actively managed products with low tracking error and active share have experienced uninspiring returns. Additionally, within the secular growth allocation, all of the large internet and consumer-oriented companies reside here, and a lot of them continue to be under pressure from the heightened regulatory environment in China. If you remove those companies from the secular growth category, the investable universe within the EM benchmark falls closer to 30%. This is just more evidence of why you should take an active, we believe, approach to investing in emerging markets. I'll now turn it over to Sara, who will provide you with a portfolio update, which begins on the next slide.
Great. Thank you so much, Doug. I appreciate it. That was really great overview to give color on how the strategy is positioned and the volatility we continue to experience at the start of the year. I'll now provide a portfolio update of 2021 and specifically the final quarter of the year. If we could go to slide 9. As we review a very volatile 2021, you can see here that the final 3 months of the year were marked by heightened concerns over inflation and the emergence of the Omicron variant of COVID-19. Emerging markets underperformed other broad market indices, with the emerging market index returning negative 1.3%. Growth equities with high valuations significantly underperformed. And this underperformance, as Doug highlighted, started in November really at a more accelerated pace as the Fed removed the word transitory from its language regarding inflation. This immediately raised concerns about the potential impact of inflation and, more importantly, how a rising rate environment would impact valuations. And so this resulted in underperformance of growth stocks across the entire globe, including emerging markets. Against this backdrop, the Jennison Emerging Markets Equity Strategy capped off a volatile year by underperforming in the fourth quarter with a negative 5.8% return, as you see below. Now, with respect to the full year, the emerging market strategy still outperformed the index by 2.1%. And this was led by strong stock selection within consumer discretionary, communication services, information technology, and healthcare, despite the fact that some of these sectors were noted underperformers and lagged for most of the year. And this was the fact that this outperformance occurred despite the fact that in 2021, emerging market value posted a positive 4.2%, while emerging market growth had a negative 8.4% return. So it truly shows that despite the tough backdrop, the strategy, by focusing still on growth, can still outperform. In terms of the risk-adjusted returns for the strategy, this slide really highlights the strength of the strategy. As you would imagine, given our concentrated growth approach and the fact that alpha is generated in those 2 quintiles, as Doug highlighted, upside capture is in the highest quartile ranking. You see that on the right-hand side of the chart. But the strategy notably also has favorable downside capture. And this is really shown by when you look at the Sortino ratio, which is a better measure of risk-adjusted performance, as it considers downward deviation instead of total standard deviation of portfolio returns. And this is in the second quartile. This is another interesting chart. And as Doug highlighted, when you look at rolling returns over a shorter term versus a longer term, 1, 3, and 5 year period, as you see here, you can observe that over a shorter period of time frame, there can be swings led by many factors. And clearly 21 shows a lot of volatility. But when you consider over a longer term horizon, 3 to 5 years, you see a steady return as the strategy really is positioned to capture alpha over time of that longer duration secular growth focus that the strategy has. I can really now focus on China, the largest weighting the index. As I've already mentioned, China was a large underperformer in 2021. When you look at our weight in China over time, you can see 2 things. The first is that we move in and out as opportunities emerge or growth narrows, as we've seen in 2016 and 2021. You can also see that the period leading up to COVID, our China weight moved upwards and reached a record high of 58% in the summer of 2020. Starting in the fall of 2020, we started to lower our weight in China. Initially, it was a very measured process, as our analysis of growth across the China large cap internet companies showed that growth was maturing. So we started to move weight into more higher growth opportunities across emerging markets. which is what the strategy leads us to do, is we really focus on growth and move toward growth as the highest. Then in early 2021, we started to take gains in sectors like healthcare, where the companies had delivered on strong pipelines, and we were identifying other growth opportunities in other emerging market regions. But eventually things really forced us to take a swift departure in the second quarter of 2021, when you see that big drop down as the broader regulatory headwinds that had started in technology started to hit more sectors across the Chinese market. While we have added a little bit back to China, we're currently at a 20% weight, still materially underweight the index, which is at 33.6%. But here, what the key to take away is, because we're focused on growth, even in large index weights like China, we move in and out as we identify. As we move out, obviously, as growth starts to decelerate, favoring regions where we're identifying faster growth. As a result of our agnostic approach relative to the benchmark, the strategy has a very high active share. You may note the drop in active share in 2019, and this was largely because we were positioned in large cap China internet names that had gained prominence in the emerging market index prior to COVID. And we held these, obviously, in the portfolio at very sizable weights. This, as I just mentioned, changed in the summer of 2020 as we saw growth maturing in China large cap internet. So you can see that as we started to exit those positions, active share rose again to the more normal 90-95 range, currently at 96%. Here you can see the returns of the strategy by sector for the full year 2021 and the fourth quarter of 2021. For the full year of 2021, consumer discretionary, industrials, communication services, and information technology led the outperformance. In the fourth quarter, however, this reversed, and the vast majority of the underperformance, which occurred in December, happened as growth stocks sold off due to those inflationary concerns, heightened by Fed commentary, and sectors like communication services and information technology materially underperformed. Within consumer discretionary, full-year excess returns were the highest, led by Li-Ning, China's largest sports apparel company, and Titan, an Indian manufacturer of retailer of jewelry and watches. While the fourth quarter holdings in the consumer discretionary sector held up, they only added modestly to value. But it was very encouraging to see that in this sector, we still maintained positive returns. Within communication services, despite the huge reversal in the fourth quarter of 2021, for the full year, the sector was still able to return 1.6% after the strong returns earlier in the year. But during the fourth quarter, the sector really took a hit as our top holding, C Limited, detracted materially for performance. Because we take a long-term view, we see that we saw encouraging signs in the third quarter results, which showed that while there might have been a slowdown in gaming, e-commerce growth remained robust. And we believe that the e-commerce opportunity across Southeast Asia continues to offer long-term growth opportunity, with C ideally positioned to capture that ongoing shift from offline to online, with optionality as the company has been moving abroad to new markets such as Latin America and Eastern Europe. Within industrials, Chinese EV battery manufacturer Contemporary Amperex, or CATL, and medium-heavy truck manufacturer Leland led the outperformance for the year. In information technology, full-year outperformance was led by semiconductor companies, TSM, Taiwan Semiconductor, and Silergy, as well as Globant in IT services. Looking at the excess returns by country, you can observe that our underweight in China, but also stock selection, contributed positively to returns. This slide provides us with more stock level returns in the fourth quarter. While top holdings such as Silergy and Globant and CATL were positive contributors, I would note that not only large cap internet names out of China, like Alibaba and PDD, helped relative performance as the shares of these companies continue to underperform. However, on the detractor side, top holdings such as C Limited and Mercado Libre underperformed as high valuation growth names sold off on inflation concerns. Despite the weakness during the quarter, we continue to believe that the companies are well positioned relative to peers in their respective regions, given the still low level penetrations of e-commerce in their home regions. And you have the added optionality of the growth opportunity offered by FinTech for Mercado Libre and the entry into new markets by C. This gives you a look at how we're currently positioned as we exited 2021. The largest change in the fourth quarter was an increase in our financials weight from 9% to 14%. We initiated new positions in Brazilian fintech company new holdings, Indonesian regional bank PT Bank Central Asia, and Russian online retail bank TCS Group or Tinkoff. Within consumer discretionary, our weight decreased from 24 to 20% as we trade Mercado Libre as part of our risk management, as the Brazilian Central Bank stepped up its rate hiking cycle in the fall of 2021. Risk reward in the near term was materially to the downside on a top 2 holding, so we cut the weight in half as Brazil navigates a tough near-term outlook and growth has been out of favor in that market. In healthcare, our weight also decreased from 14 to 10% with elimination of China biotech company Innovent Biologics and Shanghai Fosun Pharmaceutical. Consumer staples increased from 2 to 4% with the addition of India's Avenue Supermarts. The portfolio's weight in communication services also decreased as we sold Kakao Corporation, an internet company out of Korea, as the company also faced regulatory headwinds, limiting its ability to expand into new growth areas such as wealth management. And finally, within industrials, the addition of digital freight platform Full Truck Alliance brought our industrials weight from 10 to 12%. We move to slide 8. You can see here that we meaningfully have been adding to India, and it's now our largest country exposure at 33%, and it actually moved up 3% at the end of the quarter. China is still our second largest country exposure at 20%, but it's still a significant underweight relative to the index and far from the 47 weight we started the year at 2021. We also brought down our weight in Argentina, and this is predominantly due to our material readjustment of our weight of Mercado Libre as part of our risk management process. In slide 19, I think this is a very comprehensive summary of the characteristics of the portfolio. The strategy is positioned in companies with the strongest top-line growth across emerging markets. The strategy is tilted more to mid-cap, large-cap names versus the benchmark, so the weighted average market cap is lower, but the median market cap is well above the index. And the strategy is concentrated with 37 holdings and a high active share of 96%. So as we look to 2022, we believe that secular growth opportunities are still available and abundant in emerging markets, and it remains the focus of our portfolio. Going forward, we believe that the recent moderation in valuation creates a favorable environment for the superior growth characteristics that we seek over an extended investment time horizon. Many of our long-term holdings continue to have solid and resilient fundamentals and should see their business models and brands win out over time, even as we learn to live with COVID and the reopening trade fades. As we start 2022, a lot is priced in, making EM assets particularly sensitive to any upsides and positive surprises. Some potential catalysts could include positive developments regarding the path of the pandemic, easing supply chain constraints, stronger growth out of China, and peaks in the emerging market in US inflation rates. We continue to like the structural long-term growth underpin of emerging markets, and at Stock Pickers, we see recent volatility in emerging markets as creating compelling opportunities. The Jennison emerging market strategy focuses on structural growth across emerging markets, and this has not disappeared. Structural growth of EM remains in place with demographic dividend, urbanization, the emergence of the middle class, the shift from offline to online, with penetration of technology, digital payments, fintech, digitalization of the enterprise, still in the early stages across many emerging markets. Growth was indeed pulled forward due to COVID, and the market needed to digest that. But in fact, COVID has only accelerated the paradigm shift that we had already started to see across emerging markets prior to COVID. If we go to slide 20, this just gives you a view of our top holdings as of the start of fourth quarter and year-end 2021. I would highlight, while some of the weights have shifted due to our risk management, namely Mercado Libre, and market action shifted weights in names like C Limited, our top holdings have not changed materially. We take a long-term view to the secular growth companies that we've identified across emerging markets. With that, thank you so much for your time, and I'm happy to take Q&A, Abhishek.
Wonderful. Thank you, Sara. That was very, very descriptive, very, very detailed. And, the points are very, very clear. I'm sure audience can give a sigh of relief, post the huge volatility that they have all been subjected to. But, with the long-term track record, and I think very, very clearly the aspect of growth clearly ruling the large part of capital market returns should give them a lot of confidence going forward. On that note, for the audience, please don't stop writing in your questions. The first ones that have come in and some that we have collected while building up to this call. Let me start asking them, Sara, and we will take then live questions from the Q&A box. So the first one is more so from perspective, and you have clarified our stance on China. But the first question is more so to talk about, while the absolute size of China in terms of being one of the largest economies now, do you think there is merit in treating China separately in terms of the size and scope of opportunities, and hence as a separate part of our portfolio? What would be your thoughts on the same?
Well, as you know, the approach is fundamental bottom up. And so we're agnostic as to benchmark country and sector. So the strategy as it stands, it wouldn't be limited in continuing to invest in China if there was this major shift, because we really are focusing on more of the companies and their inflection or acceleration of growth. Now, what really would alter is the benchmark itself that is used for the emerging market asset class. So it would require quite a big adjustment if you took China out of the asset class. And it's interesting at the timing, given how battered China was in 2021. So, when you look at returns in 2021, China posted a negative 21.6 return in 2021. And as you know, the M index was down just 2.5%. So that implied that ex-China, for the first time, posted a very nice positive return in 2021. And so when you think about the exclusion of this, at this time, it would seem to be beneficial, but the historical track record shows that China has been a very positive contributor to the index. So it would really alter how the asset class, the benchmark of the asset class, and that could be problematic. But there is a lot of talk of doing that. We still would be, and some of our names are not in the MSCI index because we really are focused on more the secular growth that is across emerging markets. I think only if China becomes a developed market would that alter our ability to access this market. But it certainly is something that has been on the table. We'll see, because it's a material adjustment to the benchmark of the asset class.
Wonderful. Thank you for that, Sara. And as expected, there are questions circling China majorly. So the second one is also on China, where I think it's in line with our portfolio stance. We were earlier holding on to the concerns around the growth trajectory of China as an economy because of the backdrop of unclear policy stance on specific sectors, and obviously we have dropped allocations to a very low number. It also seems that we have kind of turned a corner as far as coming off the low allocation. So is there a change in the portfolio stance going forward?
So again, we still remain active in China as we continue to see pockets of growth in the region. So because we're fundamentally bottom-up driven, our initial move to lower the weight in China was really fundamentally driven as we saw deceleration in growth of China's large cap internet companies and a new investment cycle. So we moved to lower that weight. Now, what was unique about 2021 is that really the regulatory headwinds that hit later and hit late in 2020 and were amplified in the middle of 2021 really was a unique one time. We think that there isn't going to be a reversion to the mean. This is a structural shift that the government has taken with the common prosperity stance. But, our decisive move was because the growth case had been altered. At the same time, we still continue to think that there are pockets of growth in China. It just means that as stock pickers, we have to be pickier and really be in sectors that are aligned with the government's objectives. So these are sectors, for example, like green energy. China has committed itself to raising its non-fossil fuel share of primary energy to 20% by 2025 and 25% by 2030, and increase the total installed capacity of solar, wind, and this would include electric vehicles. So we see it very compelling long duration opportunities there still. Also in the localization trend, you see it in healthcare and in semiconductors. And then, so it's clear to us that the shift in China policy isn't going to be a one-time thing. It won't be a shock that will dissipate over time. So that necessitates an underweight in the region, but it also, gives us a focus on companies that have less policy risk and that still have a high earnings potential and are aligned to the necessary goals of the Chinese government. So we still think there's opportunities. You just have to have a sharper toolkit in identifying them in China.
Perfect. So what you're saying is that from an opportunity standpoint, we are always open. And as soon as we see the growth trajectory come back, we will up our weights. And that gets me to the next question, Sarah. And while you did point about how we have opportunistically played China even in the earlier cycles, what brings me to the point is that while even in this cycle, India, Taiwan, and Korea stand to be beneficiaries of the underweight that we have created in China. Can you talk about some of the specific opportunities? And also, while you're talking about it, can you also maybe highlight a little bit about, if I go back a little bit in history, 2017 and 18 beginning is when we were practically negligible weight in India from a little bit like a double-digit weight in India earlier. And, by the end of 2020, if I was to be very particular, 2020 October is when we increased our weights back. So what really changed?
Mm-hmm. Yeah. So first, I would like to note that the strategy does not take a top-down view. Our sectors and country weights are really a consequence of the bottom-up approach. Now, these countries would appear to be the beneficiaries of our underweight in China because as growth opportunities re-rated in China, then growth shifted into some of these other countries. So, and I would also note that, and you highlighted, we were already positioned in these regions. And in effect, as we exited China due to the regulatory headwinds, the first step that we did was to concentrate the portfolio furthest in our highest conviction holdings. And these were some of the companies that were in these regions. So for example, we see a sizable opportunity in electric vehicles offering long duration growth. And the strategy has focused on the battery supply part of the chain of this opportunity, led by battery companies like Korean battery manufacturer Samsung SDI, which has been in the portfolio since November of 2018. But we added material weight as we were trimming China Internet. SDI is uniquely exposed to European EV markets and OEMs like Volkswagen and BMW, and Europe is one of the fastest growing EV markets. At the same time, I would note to highlight how we continue to look for opportunities even in markets that one would say are out of favor. At the same time as we were leaving China, we initiated a position in one of the largest EV battery manufacturers in the world, which is based in China, and that is Contemporary Amperex Technology, or CATL. The company had been expanding capacity as China's domestic EV demand was recovering, and purchases were no longer supported by government subsidies, as these had been removed. So with real organic demand out of China and demand from Europe rising, this name has become one of our top holdings. Another growth opportunity we've seen is that semiconductor localization trend propelled by the disruptions during COVID and the geopolitical tensions that had been occurring prior to COVID. Semiconductor companies such as Taiwan Semiconductor and Silergy are out of Taiwan and are our top three holdings are within our top three holdings currently, highlighting how much conviction we have in these opportunities. Now, India is a very unique case. And yes, India now is our largest weight. But I would say that even before we exited China, we had already meaningfully moved to add weight to that region. Because when you think about India, it truly is the last emerging market, pure emerging market out there of size. GDP per capita is low. The country has great demographics, with the population set to surpass China in the next decade, a high savings rate with long duration growth opportunities in the region. The proliferation of smartphones is unlocking productivity, liberalizing both, the labor force and the rural population. And what was interesting throughout the course of late 2020 and 2021 was the opening up of capital, now leading to a surge in IPO activity in India. So for example, in 2021, we initiated a position in Zomato, the largest online delivery company, food delivery company in China, in India, as we saw, new sort of refresh of the market. What's been interesting in India through the period of COVID is that, we removed weight as COVID spread through the world. We actually went to a negligible 1% weight in India as we saw valuations still very not really factoring in how COVID would hit the country. But in the fall of 2020, leading economic indicator showed us that India had really done a good job through the worst part of the initial wave of COVID, and that economic activity was surging. So we re-entered quickly back into names that we knew had very long dated secular growth opportunities. And so as we entered 2021, we were already overweight versus the index in India, and names like HDFC Bank, Ashok Leyland, Titan, Asian Paints were already in the portfolio. And when we looked at alpha returns, these all generated positive alpha across 2021. So that move to a weight of 33% where we sit today was part portfolio action adding to India, but also just the alpha that India generated through 2021. It was a relative outperformer during the year. So really it is about where we're identifying growth, and we're seeing not just the traditional growth really strengthen in India, but also new opportunities are opening up as more capital flows are leading to a surge in IPO activity.
Wonderful. Thank you, Sara. I think that underpins the whole, the whole aspect of how the strategy is really positioned. That brings me to the next question. And I know you have already raised the flag of we not really being a top-down manager, but, with this whole background of quantitative easing or the lift off, as we all know, and whenever there is a word around that, there is always quite a bit of upheaval in the emerging market, specifically in the listed part of the capital markets. This time, the QE is also accompanied by quantitative tightening, the QT, or balance sheet reduction, as we call it. Can you, in that line, talk about some of the top-down and bottom-up developments that would be helpful for the audience?
Yeah, I think what's interesting is that this is really going to vary by region and the specific opportunity of the company that you're looking at, because something that I think people are missing is the fact that in some large emerging markets, I'm thinking Brazil off the top of my head, they started to hike in 2021, moving much earlier than the US Federal Reserve to curb inflation, while in fact, China is doing the opposite, they're easing. So while admittedly, the Fed actions will set the tone for investments throughout 2020, 2022. And this, we'll see this through the pass-through to effects, and we'll certainly keep an eye on that. From a bottom-up perspective, there are still healthy activities in markets like China, India, in terms of IPO activity, companies that are still coming to market. And what has actually changed is that valuations have re-rated of comparables to these IPOs, but just valuations have re-rated. So that's opening up opportunities. So yes, while quantitative, rising rates, quantitative tightening narrows the opportunity set, I don't think it becomes zero. It doesn't diminish it. It actually opens up some compelling opportunities to enter into companies that have, derated below where the fundamentals would suggest. So we see still this creating an environment of opportunity.
Perfect. So what I hear you say, Sara, in other words, is that while the growth opportunities may reduce, the scarcity premium for the companies which are growing faster will still continue. So hence, for a strategy like us, the opportunities are even better. Great. So that brings me to the end of the prepared questions that we had collected, from the audience while building up towards the call. I would want to move on to certain live Q&A questions that are sitting in the box, some very, very interesting ones. And I'm conscious that on some of them, you've already commented while going through our portfolio stance. But one of the questions which is very, very important, Sara, is that while some of our top holdings have really oscillated and gone down by 20-30% also, one is that what is our stance on some of these holdings? And second, how does the risk management work in situations like this?
Yeah, so certainly on the last slide, you can see some of our top holdings. So I think when you think about the fundamental growth opportunity that we still see in themes like e-commerce ex-China, mainly LATAM and ASEAN. This is in MELI and Mercado Libre and C Limited. Penetration there is still very, very low, and there's a lot of optionality that that the correction is now giving you for free. So, when you think about the concern of C Limited, everybody's concerned about gaming. Gaming growth may slow, but the company still generates about $3 billion in cash just from the gaming business. That $3 billion that it can invest into the business, into the e-commerce side of the company. We are, looking very closely at when the company can turn more profitable in the ASEAN. It's still investing heavily in the investing phase because penetration levels are still very low. So there's still a lot of growth for the company to deliver upon. And in fact, it did a capital raise in the middle of 2021. So it has a 20 billion cash reserve to really push through this tougher period. No one doubts it'll be a tougher period, but I think it's one of the companies that can really deliver. And on the other side, you have a company like Mercado Libre that is already a dominant player in LATAM, but you still have internet penetration that, only in Brazil has it broken through the 10% penetration level. Across the rest of LATAM, it's still in the single digits. And so there's still that secular growth opportunity. And we've seen, and because Meli we've been held that since the strategy was conceived, which was, back in 2006, 2008. We've seen that when you have a secular underpin, there may be periods of volatility like we are living through today, but that secular growth underpin can at times protect you from the macro headwinds that can hit a specific company in a region that is tougher, if you will, such as Latin America, where you face not just slowing macro, but a lot of foreign currency pressure. Because that secular underpin is still very strong for Mercado Libre, we see that this is a long-term fundamental winner in the LATAM e-commerce market. And that additionally to that, at the current levels, you're getting the fintech opportunity, which is one that is twice, potentially 3 times bigger than the e-commerce opportunity in LATAM. You're getting that for a very cheap, almost zero valuation. And so the market tends to overreact on the up and down, as we saw some of these valuations were stretched. As we were living through COVID and everybody saw the utility and the value of these companies. We don't think this has changed. This actually, as I mentioned, has accelerated as consumers have shifted online, enjoyed their experience, seen the value of moving online and have remained online. And those older cohorts that were already online have only increased their frequency. So as these companies bolt on more products and services to their platform, we see that growth will continue to accelerate as these companies are accessing even bigger addressable markets. So we continue to be very positive on these companies, but at the same time, we understand that the near-term headwinds, there are risks. And that is why in a company like Mercado Libre, because the discount rates really have risen materially in Brazil, you went from rates going from 2% to 9%, and Selic could hit 12% sometime this year. So that necessitated risk management, not having a 8% weight in that holding. We cut that by half, but it really doesn't alter a fundamental view. Now, longer durations opportunities such as electric vehicles that we see, again, we're at the early stages of that. So these companies, we have not altered the positioning or the weight in the portfolio because we think irrespective of what's happening globally, we're seeing solid demand out of Europe, US, Tesla, and China, using these manufacturers to access this very compelling opportunity. Again, the other one is localization trends. We're seeing that in semiconductor, healthcare. It creates compelling opportunities, and we're ideally positioned there. As countries really post-COVID are assessing their supply chains and what they need to have more locally versus what they're willing to outsource. So, these are fundamental long duration secular growth opportunities that we see across emerging markets. And that we think, again, has not shifted, and that's reflected in the top holdings that we have in the name in the portfolio. India, as well, as you see some of the top holdings that we have, Ashok Leyland, HDFC. There's still plenty of growth that India offers. The reform agenda, the budget was recently released. Perhaps it wasn't the high capex cycle we'd hoped for, but it's still a respectable growth level, and there really isn't any other region in the world where we're seeing the type of growth that we're seeing out of India. So hopefully
Wonderful.
that answers that question.
It does, Sarah. I think it's pretty clear. I think that brings me to a very, very interesting, longish question, but a very, very interesting and very, very pertinent to what we do here while managing money. And it is more so about, asking that while we put together our investment strategy, one of the assumptions that we have is that fast growers will continue to grow, at whichever valuation point it is. And the question or the example that has been pointed is Tesla from a global equities perspective. So one is, how do we go about our assumptions? How do we follow through? And do we think as a team that at such crazy valuations, the expectation built up can be actually ending up being very, very disappointing in terms of future returns?
Yeah. See, valuations is really a function of your E, right? It's what E are you using? Whether it's price to earnings or EBITDA, it's that denominator. And really what we do as growth managers, you really have to spend a lot of time, running simulations around what that E could be, what the EBITDA could be over time. And that's really going to drive your comfort around what the market is assessing and valuing that company at. So we aim to get at that E before it inflects, right? And so Mercado Libre, for example, is a great example. I'm not going to use Tesla because I'm not the Tesla analyst, so I'm not an expert there, but I hear what the question is pointing at. So the fact that we were very early to a company like Mercado Libre, Limited, cattle out of China for electric vehicles, is we identify the growth, but we're trying to position ahead of that inflection in growth. And so you really, by catching that inflection, it's because we've assessed a much bigger, longer duration E than the market has. So it appears highly valued when you take that near term, shorter view that tends to happen, especially consensus, sell side consensus. And so the market becomes very fixated on the valuation. Now, it doesn't mean that we ignore valuation. So for example, again, large cap China internet is the perfect example of that. Because we're so focused on the E, when we see E start to slow down and we immediately pause and look, is there something structural that is causing that growth? Is it a new investment cycle? Will it lead to even faster growth? Are we entering new markets? Are we adding new products? Are we moving into new markets that for now necessitate an investment but going to lead to higher growth? What we saw in the fall of 2020 was that growth was maturing. There was an investment cycle, but it was very questionable that it would lead to much material growth acceleration. So we started to trim. So when we position early in that inflection point, we move meaningfully in weight. When we start to see growth decelerate, we actually take the reverse action. We start to trim, waiting to see if there's a second leg of growth. When there isn't, we exit. I mean, something notable about Jennison is that, when Alibaba, hit the snag with Ant Financial being, taken out and the regulatory headwinds rising and Tencent started to slow, it took a couple of weeks, but the entire firm exited. That's the conviction of not just on the buy side, but on the sell side. It took swift action once we saw that growth was going to be very much limited, given now not only the maturing of the industry, but also regulatory headwinds. So it's an example of how we take swift action. And we've done that. And so when we see near-term really heavy headwinds like we're seeing in Mercado Libre now, we take that weight down. Fundamentally, we see nothing wrong because we still have firm belief in our E. And we know that at times the market valuation suggests that it is already pricing in everything, but it is a function of that E, the analysis that we do. And I think that's what differentiates us is we take that longer term view. We try to be earlier to the inflection of growth of companies that we identify as having long secular growth. But when anything alters that growth, we take swift action.
Perfect, Sarah. So what I hear you say is essentially that we are pretty clear about the trajectory and the acceleration of growth rate for our set of holdings. And if any of those hypotheses get really in the questionable zone, we would review and take a corrective action as may be appropriate, which ensures that from a risk management perspective, we will in more cases than not be able to have a decently good downside protection, which I think the downside capture ratio shows, as well as at all points of time, the up capture ratio remains very, very strong. Now that connects me to another question in the Q&A box, which is more so pointing out at the huge deviation or the huge detraction in returns, which has come up specifically in the last quarter of last year. And I think when if you were to look at that in a very pointed manner, it probably looks like one of the largest detraction in the history of the fund. But I am careful in terms of saying that even in the earlier cycles, when we have had a cyclical catch up or a value catch up, early in, let's say, 15, 16, and so on and so forth. So what can you maybe point out a couple of those time frames, and how did the portfolios react in those time frames to just put things into perspective?
Yeah, so I would say, 2016 was a year that was value driven and had, two shocks in the same year, right? We had a lot of concerns at the start of 2016 about China and U.S. growth, and value very much that growth value gap had widened, and it closed very rapidly. When that happens, our strategy, it really cannot outperform, right? But it's because we take that long-term view, as Doug mentioned, and highlighted in his portion of the presentation. Right now, we're seeing that inversion in returns in those quintiles, right? And that can happen. But when it comes to value, it's a reversion to the mean. When you think about the earnings power of these companies, it doesn't hold a candle to a growth company like a Melli or Mercado Libre or a Tesla or C Limited. This is just a catch up, a reversion to the mean. We are, this time period is unique in that we also have obviously the support of reopening, a cyclical reopening that is unprecedented in history. But we also have supply chain constraints. They're lifting prices of commodities to levels that, don't make sense. This is not real, not supported by a real underpin. It's not like China is rebuilding, or, perhaps India can build at the level that China did in the mid, 2000, the early 2000s into the late, into 2008. There isn't a real commodity cycle happening. So these are shocks. They're temporary. We know from the experience of 2016, when the fund was live, that these points of pressure, really what they force us to do is to really take a hard look again at our holdings, look at the fundamentals, look at the earnings potential, the trajectory of growth. And, once things have re-rated, we actually move more meaningfully into some of our holdings. It's actually what we did with things like Mercado Libre at that time. We actually we gained higher conviction in the fundamental underpins of some of these companies and identified new companies. And I think one of the things we're excited about is the opening of capital markets in India, more activity also out of ASEAN. And that's really exciting to us. This is about bottoms up fundamentals. And while there are factors exogenous that can impact sentiment towards growth versus value, these tend to be short-lived, as Doug gave you the statistics. And so the aim of the strategy is that longer duration investment opportunity, looking for those investment opportunities, because over time, our analysis shows you want to be in those two quartiles, because that's where the alpha is generated. And the companies that are in those two quintiles tend to be in consumer communication services, information technology, and healthcare.
Wonderful. Thank you, Sara. That was very, very detailed. Having said that, let me quickly make a point to the audience. And I think once the presentation gets circulated, and while Doug and Sara were talking about the presentation, you would have seen on slide 20 about the forecast in terms of how the portfolio growth is getting pegged. And more importantly, if you were to look at in history, the last 3 years of growth, and let me point out, without really looking at numbers in specific, that the growth that the portfolio has really generated is more than double of what the index has generated. And when you look at it in future, and here's the slide in front of you, if you look at it in the future, I think the growth again is extremely, extremely strong against the benchmarks. So the point that I'm trying to make is that while I do understand that from a fundamental aspect, valuation becomes one of the larger concerns, specifically in a time where interest rates is hardening. But at the same time, here is a portfolio that cuts through the noise, looks at a very, very fundamental view to growth and accelerating growth. And if I was to, again, connect the dots to exactly where I started this evening presentation from, is that is the biggest challenge that we have while scoping for returns in emerging markets. The index is not the best representation of the portfolio that we should own, specifically because if you were to again go back to what Doug mentioned, that the top 2 quintiles of the earnings growers explains more than 2/3 of the market performance, then clearly what you need in the portfolio is for somebody to be able to scope for growth and be able to cut through the noise, get your head down, and stick to it to be able to deliver performance. Over a longer period of time, the team here has done that, and we are very, very excited to really see the future prospects of this portfolio. With that, maybe I'll quickly put out the last question, Sara, and that's a little pointed on one of our portfolio holdings, which is Zomato. So if you would want to talk about Zomato again from a valuations plus, what do we see compelling as an opportunity in Zomato?
Yeah, so Zomato is really, what we're seeing now is, that India's market is opening up to new economy companies, and Zomato is one of India's leading online food delivery company. What we really like about this company is two things. People think of online delivery and maybe you think of China, where a lot was given for free. It's a very fragmented market, many competitors. It got very competitive, very tough. But in India, what's very interesting is that prior to the IPO, the market was already consolidated to 2 players, and Zomato is leading that with a 50% market share. But when you think about penetration, there's really about only 8 to 9% of food consumption in India from restaurants versus 40% plus in China. So we're still in the very early innings of a very long dated secular opportunity in a market that's already consolidated. So we're very excited by this opportunity. And also what we're seeing is more companies in the new economy IPOing in India in tech and in healthcare. And that's certainly where we are quite active.
Wonderful, Sara. That kind of brings us to the end of the call today. I hope we are able to make sense to what is happening in the markets and how the portfolios are really positioned. Thank you, Doug and Sara, for taking out time in the morning and taking us through this detailed analysis of the portfolio and the markets. Thank you to all the audience for taking out time on behalf of PGIM India. Let me thank you for taking out time in the evening and spending that time with us. Before closing on, Sara and Doug, any closing remarks that you may have? Else we could close the call and look forward to an engagement in the next quarter.
Well, I would just love to summarize the fact that, this strategy is very active, unconstrained, and concentrated. We're bottom up. We really build the portfolio one stock at a time. I hope you got that flavor. We're truly benchmark sector and region agnostic, and we're long-term. We focus on secular growth companies, and we typically take a longer view, a 3 to 5 year view of companies that enter the portfolio. So thank you so much for your time, Abhishek, and everyone on the line.
And I'll just echo Sara's comments as well. And, that we are very long-term oriented investors, but we can go through short-term periods of rotation, which we are in today. But I think it's important to know that it is not a fundamentally based rotation. We've been through many of these rotations in the past. And as long as you're able to stick to the fundamentals and find the best growing companies, these rotations tend to be short-term in nature. But I wanted to thank you for your support and efforts and helping us with our products. And if you have any questions down the road, please reach out. We're happy to answer anything. Thank you.
Wonderful. Thank you. Thank you, Doug and Sara. Thank you, everybody. With that, we close the call today.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.